Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
My gosh, is a week gone by again? Another week passed like that. Hey, hi, welcome to the show. This is a show about your dough. We're going to focus on money for the next 2 hours on Como Radio in Seattle. Even though it's 9/11, we are going to focus on your money because this is important. This is your future that we talk about, and we want you to live the best possible future. And to do that, you do need help. You do. Please face facts. You need help because most of you do this so badly. Some of you do it well, but a lot of you don't do it well. So call us at 855-935-TALK, T-A-L-K 8255, 855-935-8255. You can call that number right now. We got lines open because we want you to stop doing some of the things you're doing. And we don't want to be party poopers. We love the fact that the stock market has been rising for like ever, except for a few pauses when you guys thought it was going to plunge and you were wrong. Someday it will do that to you and it'll stay down for a while. Problem is we just don't know when. However, you got to avoid the other, Tom, and that is getting way too confident in, well, let's face it, abilities that you really don't have anyway. You just think you do.
Well, we all think we do. Yeah, we're over. And by the way, the reason we raised this is $16 billion flowing into U.S. stocks, both the individual stocks and exchange-traded funds in July, $13 billion in August, very high by historical standards. And as you just pointed out, Don, one expert saying sooner or later the financial markets will need to price in various scenarios as we transition from early to mid recovery cycle. So here's the thing.
Okay, now wait. Yeah. Before you get into, I hate it when people say that early to mid recovery cycle.
Laughing.
Like they're they're making it appear that you can predict the cyclical nature of it. We know that stocks go up and we know that sometimes they go down. Period. Go ahead.
But the thing is, we also know that many of you feel that you can pick stocks. See it every day, right? I'll own XYZ corporation instead of another corporation. You have a tendency to believe that your trading is going to work out to make more than the market. Again, the track record is that you cannot. And here's the third part. The new work that shows that the people that do this for a living, the people that have hundreds of millions of dollars that they trade every day, that have all the research, they got everybody to do the work. They cannot beat or have not beat the market.
Well, actually, the research shows that some of them have beaten the market, but these are people who live, eat, and breathe picking individual stocks and playing the market. But that's before the costs.
Yeah, you got to figure that part in.
That's before their trading costs and their fees, the fees and commissions and things. After that, the evidence is overwhelming that when you factor in expenses and fees, that it is not just unlikely, but nearly impossible to predictably and consistently do better than the market itself does. And I know a lot of you rely on, it's not evidence, folks. It's called anecdotes. Oh, a friend of mine, he put his money into the stock and did really well. Yeah, okay. And a friend of mine once won a bunch of money in the lottery. Does that mean I should be investing in lottery tickets? It doesn't follow. It's a false equivalency. you're fooling yourself. And if you've made money recently in stocks, well, so's everybody else. Doesn't make you smart, just means you're average at best.
So we'll talk a little bit on the program about what you should do instead. But one of the things you should do when it comes to all of this, money in general is another topic around all this, Don, that I see, is people have trouble being honest with themselves. They're nostalgic about their stock purchases. And nostalgia is a happy look back, right? At the good times.
Yeah.
Not the bad times.
Back when I got double-digit interest rates on my savings account, those were the good old days.
Yeah. And so you have a tendency to forget picking, like Washington Mutual or Enron or some of the other stocks that have not done well. Or we'll talk about another category here in a few minutes that was making everyone rich very easily, and then it turned and went the other direction.
Yeah, that's that whole past tense thing.
Yeah, exactly. Didn't work out the way people had expected.
Yeah, it's like the waxing nostalgic for high interest rates. People forget that you would go to the store, and from one day to the next, something could be up 10%. We had rampant inflation, so your money wasn't worth much. It was worth less all the time. But we forget that. We just remember those high rates. 855-935-TALK. Give us a call. Set your course for a great future with a free copy of our 60-page Better Retirement Guidebook at vestory.com, vestory.com. Well, hi, it's us again. I'm Don. That's Tom. What do? We talk real money with you at 855-935-8255. Give us a call. Okay? It's free. It's pretty easy. And we're gonna try and tell you the truth. As opposed
generally friendly, even
generally we try.
Sometimes we have to tell you
when Tom's grumpy.
I feel good today. I'm not.
He's not grumpy today.
No, I'm not grumpy today.
No, not
maybe because I get to go on a trip tomorrow. I'm happy about that. Get out of town.
He'll be grumpy late Sunday, early Monday.
No, late Monday. Late Monday.
When's the game?
Night game.
Oh, it's a Monday night game. Oh,
so,
it'll be very, very like I'll be sleeping.
Don't call me early Tuesday. You'll find out how grumpy I can be.
He's going to the Raider game. Who are they playing?
Ever. Does it matter? Come on.
No, I guess it doesn't. Good point.
Exactly.
I don't know why I asked. 855-935-TALK is our phone number, 855-935-8255. And Jan, it's your time. Welcome to the show. Turn your radio down, please, Jan.
Thanks for taking my call.
Oh, our pleasure.
I just have a quick question. I am 60 years old, and I've done okay saving, but I'm confused about Roth IRAs.
Okay.
I have not got one.
Yeah.
I do have a Roth through my 401k, but I think that's different than a Roth IRA.
Similar, but yeah, okay.
And I understand the 5-year rule and everything, but now I'm wondering, I wish I had done this a long time ago. Is it too late for me to do a Roth IRA now?
So you have a little Roth envy going right now? Is that the deal?
I want my
Roth.
Okay.
It's all right. It's okay. It's okay.
She's got a Roth. She's just got a Roth 401k.
Yeah. Okay. Let me ask a couple.
Okay. Yeah.
Yeah. Got it. Okay. So how many more years are you going to work?
3 or 4, maybe.
Okay. And have you sat down to do any sort of look at your financial life post-employment? Like how you're going to pay yourself? Okay. Yeah. So because here's the advantage that maybe for the next 3 or 4 years, you switch from doing your pre-tax money in your 401k to your post-tax Roth. The Roth IRA and the Roth 401k, not a lot of difference there. Really, there's no reason to look at them
The big difference
separately.
is that with a Roth IRA, you have total control over what you invest in. You can go anywhere.
Which might be some advantage if your plan doesn't have certain things in it that we do see, like emerging markets or small cap value. There may be some reason to do that, but then you're getting into the weeds quite a ways. Here's the way I'd look at it. I would simply say, if you can afford to, from a tax standpoint today, to switch the pre-tax regular 401k to the post-tax Roth IRA, 401k, pardon me. And then when you get to retirement, you have a little basket of post-tax money. You could draw a little bit on that. You could draw a little bit on the pre-tax. It gives you some balance tax-wise after you quit.
And here's because you said you have a plan for income in retirement. Does that plan for income immediately in retirement involve using any of your 401k money right out of the gate?
No.
There you go.
So then you might be a good candidate for a Roth conversion.
Or you just switch to the Roth 401k. Do you have extra money that you can afford to invest every year for retirement?
Yes. Yes.
How much do you make a year? Are you married or single?
Married.
How much do you make a year between the two of you? Roughly.
200,000.
Oh. Well, then
208 is the cap.
Yeah, you're going to be right. You're going to be right at the cusp of being able to do a Roth IRA. You may not be able to do a Roth IRA.
You can do a Roth 401k
Exactly.
no matter what. And your husband could do the same thing if he has a retirement plan as well. Again, the reason I like it, Jan, is it just gives you a few more options in retirement as to where to draw the money from to be the most tax efficient possible.
Yeah. I think having
Question for you then.
Yeah, sure.
The plan, the 401k plan I have, does allow for a Roth conversion, rollover conversion, or Roth conversion, whatever it's called.
She can.
Should I do that? Should I take some of my post-tax money that I have sitting in that account and roll it into the Roth?
She can do a Roth conversion in the plan, in plan.
That would be very unusual, but
I think I've seen a couple.
Okay. But here's the reason you might not want to do that now, because remember, any money you move from the regular, what I'm going to call 401k to the Roth, that just adds up as income. So the reason I was saying, if you quit in 3 or 4 years, then your income goes down, your income tax rate is low, then you can do the conversion at a lower rate. So I wouldn't generally do that, especially at 200,000. I don't know, what is it, 20% tax rate or whatever. It'd be kind of expensive.
Oh, it'd be more expensive than 20 probably at that rate. So yeah, I like the idea of converting to a Roth now, because that, again, gives you that flexibility and that long-term tax-free growth, because you don't need that money. It can just roll. It can just hang out, earn money tax-free for almost ever. And then later on, once you're in retirement, you figure out what your tax situation is. Maybe then you might do a Roth conversion, and it may be that you don't want to. It just really depends on what your tax situation is then. But for now, I think doing a Roth and funding that with your new contributions for the next few years makes a lot of sense. Thank you.
So
yes.
The real question was, is there much difference between the 401k Roth and a Roth IRA?
No.
And the answer is no.
No. The answer is no. The only problem is you may not be able to fund a Roth IRA because you make too much.
There's income limits. The government only allows you, the cap is $208,000 household. That's why I was saying you would not be allowed to contribute to a Roth IRA. You still could contribute to the Roth 401k.
Thank you so much, Jan. We appreciate you being there. And David, you're next. Welcome to Talking Real Money.
Hi, Tom and Don. This is David. Just started listening to your show, and I've been burning through the old podcast, and I thought I'd ask you a live question today if I
Sure.
could.
Absolutely.
You probably know, I would suspect, Vanguard has a white paper they put out in February of this year, the case for private equity at Vanguard for accredited investors. I was wondering on your perspective in private equity investments for accredited investors in general. I have all my assets at Vanguard, but I wouldn't be interested in being one of their
guinea pigs.
I'm not interested in getting their advice for that, but private equity in general. They recommend 30% to diversify your retirement savings.
Wait, okay, I'd be surprised if they recommended 30%.
Wow.
That sounds very high.
Wow.
And I'd love to see the paper, which you can.
Oh, yeah.
So they built like a third large, a third small, and a third private equity or something?
Yeah, I'm reading the white paper right now. It's from Fran.
Oh, it is. Okay,
Frank
we'll come
here.
back and
Yeah,
we'll
let me
talk about that, David. Hang
Let me
on
look this over during the break. I'm looking at this thing, and I got to tell you, this ain't John Bogle's Vanguard anymore.
Absolutely not.
Really not.
He's doing some rolling right now, not in the right direction.
He's flipping. He's like doing backflips. 855-935-TALK, our number.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Hey, welcome back to our little get-together about money. I'm Don, that's Tom. 855-935-TALK is our phone number. We're talking to David about a Vanguard white paper that I just pulled up. I had never read it until just now, and I haven't read the whole thing because who could read an entire white paper in 1 minute? But I am a good skimmer. This was published by Fran Canary in February 2021. Yeah, he's a CFA. And it's sort of a backhanded endorsement of private equity.
Let's go back and say what private equity is first.
It's pretty much any stock that is not any business that is not traded on an exchange.
Correct. So you can own 13,000 publicly traded companies globally, right? There's all these that are trading every day. They're totally liquid. Mm-hmm. The idea behind private equity, the reason you invest in that is you're getting in early on Tesla or Apple or Micro. You're on the inside now. These are the super.
Oh, you mean
deals.
almost like a SPAC?
Yeah, we'll get into that. How did that all work out in a minute? But here's the thing. So again, my question to David or to anybody or to Fran would be, why? Mm-hmm. Why do you need this in your portfolio? Is your portfolio not performing well enough? Is there something wrong? I don't think the long-term track, and we can argue with Fran about this, the long-term total track record for private equity. Remember, you only hear about the deals that turn out well because those are exciting, right? The guys who got in or women who got in early on any of those. The ones that don't turn out so well, they don't get as much publicity.
And this is from the paper itself. A few of the major, and these are major drawbacks. Private equity is horribly illiquid. You can buy a stock on Monday and sell it on Tuesday, and you can probably sell it if it's a publicly traded stock.
Most of the time there is a market for most equities.
You cannot buy private equity on Monday and know you can sell it even a year from now. You can't. And the fees, for heaven's sake, you can buy the Vanguard Total World Stock ETF for 0.8% a year. No, 8/100.
As in victory, T as in tango. Yeah,
you get 8/100 of 1% per year. This is a direct quote from the Vanguard paper. The fees can be as high as 1 to 3% of invested capital annually. And just like a hedge fund, 20 to 30% of the profits.
Because the people that are doing the deals, they got a better deal than you do because they're doing the deals. You're just an investor in this illiquid investment that you have to hope goes to the moon somehow. By the way, this is...
in other words, they're guaranteeing themselves a return, not you.
Exactly. They're collecting money on this. I think people have it. This is no different than FOMO for whatever other. People feel like I'm missing out on something here that's really big and I got to get a piece of that. And most of the time when people do that, it does not turn out well. I won't say I guarantee that in this case, but you can go back and look. It's easy to find. You can go back and look at large institutions that have put a considerable amount of money into private equity and see how that's turned out for long periods of time. And it has not been, I don't believe, appreciably better than just owning a globally diversified portfolio of publicly traded stocks. Don?
Yeah, and again, here, this is from the paper itself. It says gross excess returns for private equity managers have to be greater than 6% per year for investors to come out ahead relative to public equities. It's expensive. It's illiquid. It's complicated. It's for and the only place where it might make any sense, and I don't even think it does there, is for people who are worth hundreds of millions of dollars.
Yeah, so you can take a flyer. Here's a couple $100 grand. If it works out, I got $1 million bucks. Great. If it doesn't, well then I'm talking 100,000.
I'm talking 100 million and up. People.
Yeah. Okay. Right. Real like Bill
Real
Gates
money.
kind of money,
Real
investing
money.
in hotels or whatever he's doing now. So no, I don't think this is a good idea, David. And I would not be using it. And again, what Don said at the beginning of all this. I have no idea why Vanguard has decided to take this approach. None whatsoever.
I think they're pandering. I think they're giving people what they want. If you want it, we're going to find a way to give it to you, even if it's not good for you. John Bogle would have said, it's not good for you. You can't have it. They're saying, sure, you want it? We'll give it to you. 855-935-TALK.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Hey, hi. Welcome back to our little thing called a show. A show about your dough. We call it Talking Real Money. I'm Don McDonald, Tom Cox over there, and you're out there listening, and we hope you call us at 855-935-TALK, 855-935-8255. Private equity. Trying to pick the hot stocks. These are things we seem to have an obsession with trying to find something special because we're special and we deserve special investments. We deserve to get into things on the ground floor. And there are a lot of people out there willing to take advantage of that flaw in our personalities. And a lot of those came out of the woodwork recently. And the last time they did was a year that will live in infamy, 2008. The last time people came out of the woodwork and started selling you blank check investments, as they were called, blank check funds. They're now called SPACs, Special Purpose Acquisition Corporations. The last time they sold these were in a big way was back in 2008. You know what happened after that? Well, they were doing it over the past couple of years. These things became hot again.
Because, again, I think, as you said, people thought they were missing out on something. And then how's that worked out? Well, a group of 137 SPACs that closed mergers by mid-February, well, they've lost 25% of their combined value. That's about $75 billion. And by the way, at one point, the pullback was about $100 billion. The offerings have gone down. The interest has died out. And again, I don't know where all this ends up, but I don't think it ends up well. And again, as we said at the time, we're not here to say we told you so.
Yes, we are.
We're here to say,
yes, we told you so.
We're here to say, why do you need this? You don't have to, just take the returns of a global market and make your 8, 9, 10% if you want to be mostly in equities. Okay. That's what it's done in the past. That's maybe what it'll do in the future. This is a silly idea. It's really a solution in search of a problem, if you ask me.
Absolutely. And what fascinates me is that these have performed horribly in what has been an incredibly strong market for small companies anyway. These are small companies, but
yes, they are.
Existing small companies, they've done quite well this year, so this is aberrant, and it points out the high level of risk in a lot of these kinds of things. And a lot of people thought, well, where's my risk? You see it right now, 25% decline, that's big.
And, I mean, how soon do you get your money back? I mean, that's another thing
right.
out of all these. I mean, there's no guarantee even 25, 50, 75. So my take is when people bring these to me, or we had a product that was given to us yesterday, an insurance product that really makes no sense for investing, is why? Why do you need this? Why do you need private equity? Why do you need SPACs? You can get the returns of the stock and bond markets. That should provide enough growth for you to put you in a good position if you're willing to save to do that.
Well, the answer to the why is because I want to do better than everybody else. I don't want to just do as well as everybody else. I am special.
I'm above average. I'm above average driver. I'm
Yep,
above average
I'm
investor.
special.
I'm above average lover. All those things. I know it. Okay.
And
it's
I'm
true.
an above average investor, and I'm deserving of the returns above average investors are destined to receive.
Get
people.
over it is my take. Get over it.
Yeah. So, and again, we did tell you. We tell you these things over. It's here. Let me give you. People often ask me, well, I saw this great years ago. I remember the ads that Alan Stanford
we
used to run in the newspapers.
Go, how is he paying that out?
And people would call the show and they would say, well, Don, there's a guy advertising CDs at 8% per month or something. Or I don't think it was that much, but it was a lot. It was a lot. Yeah. And I would go, I don't know how he's doing it, but there's something wrong with it.
And it turned out?
There was something wrong. It was a Ponzi scheme. But the fact of the matter is we can't always put our finger on what's wrong, but there are ways to find out there's problems.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, vestory.com.
For your real life and real future, Tom and Don are talking real money.
Yeah, our number is 855-935-TALK if you want to ask a question on the show, and there's an added benefit, or detriment, could be a detriment. There's an added benefit. You're going to save Tom from suffering through the longest typed-in question ever received by Talking Real Money. I am surprised this woman doesn't have hand cramps from typing this thing up.
Right? Okay. Yeah. All right. Go ahead.
We may have to cut this up into sections. She only has 6 questions.
Let's just say something. Somebody calls, we can interrupt
this question,
and we'll take your call. Okay.
It's 6 questions, but like, for example, number 4 is number 4, A, B, C,
I thought you were kidding when you said this.
No.
700 and something words?
No, I'm not kidding. All right. We're going to start with question 1.
Okay.
I love torturing him.
I'm glad I'm in a good sense of humor today. Yeah.
It seems this is her, not me.
Okay. You're playing the role.
I'm playing the role of her.
Okay.
It seems ridiculous that the Federal Reserve forces the working class to run on a treadmill to nowhere and then pay taxes on any interest or dividend amount that just keeps us even with inflation. We're taxed for staying the same. Any way around this? What am I missing?
Pass. Next question.
The answer is any way around this? No.
You got to pay taxes on that stuff.
No. You could go get tax-free bonds.
Yes, you could lobby your Congress people.
Yeah. But you get tax-free bonds, but you'll make literally nothing.
Municipal bonds that are paying.
And she lives in California, so, double tax-free might not be bad.
Well, no, so you're paying federal income tax and state income tax and tax on all this stuff.
And we all pay them their taxes. We just all pay them. And that's not, by the way, that's not the Federal Reserve. Federal Reserve has nothing to do with taxes. That's Congress. Federal
Reserve has to do with money lending.
Congressperson.
Yeah. Okay.
For a fund versus an ETF, if I keep shares in the taxable account at a discount brokerage and don't sell any shares, A, do I have to pay capital gains on the portion of the stocks that the fund or ETF sells within itself?
No.
There you go. Look, that was good.
That's one of the advantages of owning an exchange-traded fund versus a mutual fund, where with the mutual fund, you would have to.
Question 2, part A.
I thought you were kidding.
Section 1.
Oh, God.
Subtext 1. I don't know what to call it.
Come on.
If so, what determines if short or long term? Not applicable. B, number 2B. Do I have to pay ordinary?
I'm gonna go get my lunch and I'll come back.
You are the question answerer. Be quiet.
I'll come back. All right.
B. Do I have to pay ordinary income tax at my tax bracket on dividends received by the fund or ETF? Yes.
Yeah.
Yes.
Again, I don't know any way around it, but okay.
B1. Am I taxed the same on these dividends whether I reinvest in the same fund or ETF versus the cash equivalent put into my account? Yes.
Yes. Yeah.
2C.
These are kind of tax questions anyway, but okay.
2C. They're money.
Yeah, all right.
I'm 61, expect to continue working for at least 5 to 8 years. Not happy about it.
And hopefully we'll answer all these questions before the time you retire. So, okay.
She's not happy about working that
long. Working that
long.
Okay. Me either.
And have only about 15% of the rule of thumb amount saved in retirement accounts.
So the 85% is in post-tax something.
No. She's 15.
She says 15% in the
rule
retirement
of thumb.
accounts.
Oh, it either means she doesn't have enough saved or...
No. I think what she's saying is she has enough saved, but only 15% of what she thinks she should have.
That's not what she's saying.
Okay.
She's saying she only has 15.
Can we call her to get clarification?
No, she says she only has 15% of what she needs to have saved, and it's in retirement accounts.
Well, that's disappointing. So okay.
I can't afford to lose principal.
Then
in this time, would
call
you
your
let?
Bank.
I am not some caller you can abuse.
Okay, go ahead.
Let me finish the darn question.
All right.
And I also can't afford to not take risk.
Oh, come on.
What might be some suggestions? Brokers apply rule of thumb percentage recommendations that I think are out to lunch and simply touted by the industry. They're not the ones losing if it goes down.
No.
Your response, sir.
Equity index annuity.
Stop it. Oh, okay. That was tongue in cheek.
That was a joke.
Do not do that because they're terrible. Here's the deal. Here's the deal. This is the reality. Okay. We don't like the reality, but it is the reality. The reality is if you want to make more money, you must take more risk. That is not some out to lunch industry recommendation. That's just reality. You make less money when you go into safe things. It's reality.
And here's another one. At your age and circumstance, either plan to A, you like how I'm going to use the ABC thing? Yeah. A, work longer, or B, cut your living expenses down dramatically now and save more, or C,
there's a C.
Invest more, because she uses like A, B, C, D, E, whatever it is.
We're not anywhere near done. We're not even a third of the way through.
Invest more aggressively. Right?
There you go. And that's
make a bet on like an asset class that might hit a home run, like a U.S. small cap value or something.
That's the reality. Number 4.
There's no other trick.
Number 4, all in caps. Big one.
Oh, okay.
So you need to pay attention to this one. This is the big one. This is the biggest one of the bunch. And then there's still 5 and 6. But number 4 has A, B, C, D, and then sub categories under that. Okay, big one. List of priorities, criteria to strategize which types of ETF funds. And yes, individual stocks should be selected for each Roth versus traditional IRA and a taxable account. Seems like, tell me if I'm wrong, best guesses for Roth. Whatever I expect will increase overall value the most. I don't know what that means.
Only buy the stocks that go up. That's always my recommendation, by the way. Don't you think that makes sense, Don? Why would you own the other ones? Just buy the ones that go up.
Okay, so she wants to know what types of ETFs and funds should be in a Roth. You see, here's the thing.
Okay, all right, I was being silly. Yes, you want to own the more risky, more aggressive portfolio in the Roth because that grows tax-free.
Best guesses for traditional IRA versus the Roth.
Well, then that's where you're going to have your fixed income, your less risky things, because that grows tax-deferred.
What about dividend stocks? That's number.
We don't recommend just going out and trying to buy dividend stocks.
No, we don't.
Talked about
Bad
this
idea.
before on the program.
Okay, how about her taxable account? Any amount after 4 to 6 months of emergency savings.
I would make that more aggressive. I'd have that very stock heavy.
C, subcategory I, a fund or ETF that doesn't generate taxable activities.
Well,
there's no such thing.
But okay, if you own VT,
no, but she said any.
There's not going to be very much. No.
Tips.
When you sell it, sure, but not now.
Tips. Can the principal go down?
Yeah, sure it can.
International. Flatter growth curve?
I'll go with the growth curve.
International?
Yes.
You should have international in the portfolio. It's a similar growth curve. It just offsets. And then other, I must be missing something.
Yes, you are missing something. Create a basic plan, figure out how much money you're going to need, save more, invest, and perhaps work longer. How's that?
I'm not even going to have time for 5 or 6. 855-935-TALK.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And let me use the first 66.5% of that question as an example of why we offer everybody out there free time with one of our advisors. And I do mean free time to actually sit down and look through these things and try to get a plan formulated that is going to meet your needs, or at least come closer to meeting your needs than it might otherwise do. So if you want to meet with one of our advisors, it's so easy to do. Just go to Vestory.com, Vestory.com, or call 800-386-3004 to set up an appointment. Vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.